Okay, good evening everybody. As I said, this is Mark Perkins coming to you tonight, and we will be discussing the basics of trading the foreign exchange today. So hopefully we'll get a good grounding from what we learn here today, and we can obviously then apply these fundamental techniques as well as technical techniques when it comes to trading the foreign exchange specifically. Okay, so what I'm going to be going through tonight is just a quick introduction to the FX market. Some macroeconomic factors and microeconomic factors that affect the foreign exchange. We're going to look at some trading techniques called pivot point strategies, and then just a quick recap on some chart patterns. Okay, so some basic characteristics of the foreign exchange markets. They pretty much are the most liquid markets that you will get throughout the world. There is a huge geographical dispersal. So what we mean by that is obviously we have a wide range of currencies that get traded throughout the world, as well as various different trading hubs that trade these entities. The forex market more or less continues throughout the week, starting at 10:15 on Sunday, going through to midnight on Friday night. Those are just the GMT numbers that I've quoted there, so just add on 2 hours. There's a whole lot of unique impacting factors that underpin all of these markets, and we're going to go through a couple of them today. And one of the other big difference between, other asset classes and foreign exchange is that there's a very low profit margins in the transactions. The other big advantage we have here is that you're able to leverage your position, all right? And you'll generally tend to get far greater leverage here than you would with your other asset classes. And it's obviously allows you to have more bang for your buck. All FX trading is by definition over the counter. There's no central exchange or clearing house exist. Okay, so just to put it into perspective, if you have a look at things like the New York Stock Exchange, everyone thinks that that's the be-all and end-all of trading. But as you can see here, the forex market absolutely dwarfs things like the New York Stock Exchange, the Tokyo Stock Exchange, even the London Stock Exchange. The average daily trading volume is somewhere in the vicinity of $5 trillion a day. If you compare that to the New York Stock Exchange sitting at 22.4 billion, it doesn't come anywhere close. So as we said earlier, it is very, very liquid. A couple of statistics, if you break down that 5 trillion, and there's been roughly about 30% growth since 2007. A lot of that is going into your spot transactions and foreign exchange swaps. About 475 billion in outright forwards, 43 billion in currency swaps, 207 billion in options and associated products. And for the most part, 37% of the transactions happen in the UK. Roughly about 18% in the US, and in Japan roughly about 6%. Simply why UK has that amount is just because of its location geographically in the world in terms of the time zones. It's right spot in the middle. Okay, so some of the basic terminology that you will encounter when you start trading foreign exchange. The fixed contract size or lot would be 100,000. The officially quoted rate would be the spot rate. All right, so when people ask you what's the euro versus the dollar, we're going to basically quote you the spot rate. The price difference between the bid and offer is called your spread. All right, so obviously the price at which you were looking to buy would be at the offer or ask price. And if you felt that the market would be decreasing, then you would take the market at the bid price. PIP, a lot of you probably would have heard that phrase. It stands for percentage in points, which is basically the smallest quoted change in a price. For some of you that haven't heard of basis points, it's basically 1/100th of a percentage point as well. So those are some of the basic terms that you will encounter when first getting going in the sort of the world of spread trading. Some of the currency nicknames that you'll get used to hearing, and there are a couple of different nicknames, but I've just taken some of the more kind of wacky and more commonly used ones. If you're looking at the pound versus the dollar, we're looking at cable. Euro dollar would be fiber. Euro versus the pound versus the channel. The dollar CAD, which is the Canadian dollar, would call the loonie. The Aussie dollar versus the US dollar, well, that's pretty simple. Really, it's the Aussie. pound versus the yen, we've got the Geppy, and then finally the New Zealand dollar versus US dollar equals the Kiwi. So that's all pretty logical stuff, really. In terms of the nicknames, it's actually fairly pretty boring if you think about it. All right, so just a quick one. I'm not going to delve too much on this one here, but just to illustrate just the FX turnover, how it's grown in billions, from 1988 through to 2007. I don't have the latest stats there, but nevertheless, you get an idea of how significantly it's grown. This, this 3.5 is now sitting at 5 trillion. So there has been significant growth, and basically, why is that? A couple of reasons for that. Just FX as a trading class has grown significantly. There's been greater activity of high-frequency traders, so your big banks are transacting a lot more. Emergence of retail investors, and they basically make up, you and I, we make up about 10% of the daily foreign exchange volume. The advent of online platforms and these things going electronic has made it a lot more easier to transact and execute your transactions. And then finally, of course, they've lowered the transaction costs as well. Trading forex tends to be a hang of a lot cheaper than trading things such as your stocks. Right, so some of the top 10 currency traders in the world. This is as at May 2013. We can see the top of the pops there is Deutsche Bank with about 15% of the market share. Citibank, Barclays Bank, UBS. I mean, so those are the big players in the market. And obviously, if you can understand what these particular traders' views are, then certainly you can obviously start to mimic what they are doing. All right, so just a little bit of market context for you. The FX market is tiered in terms of access, and right to the top is basically your interbank. So this is where the big banks would transact. Basically, they have the tightest spreads available, 0 to 1 pip. I mean, that's simply because it's just the size transactions that they are doing. All right, and it basically accounts for about 53% of daily volume. 70 to 90% of this is actually quite speculative. So traders are just really not interested in actually taking delivery at the end of it. They're just speculating on the movement of the price of that particular currency that they are trading. Two main types of retail FX speculative currency offerings. This is where it's important for you and I. You obviously have your brokers who function as agents and dealers who function as market makers. All right, so when you go to your broker, you obviously make sure you know what sort of entity they are. Most traded currencies by value, and this is also fairly recent, and up to April 2010, but it hasn't changed too much. Basically, it just indicates here that the top traded one, it really is the greenback at the moment, closely followed by the euro. And that kind of gets played out. I think if you have a look on the next few slides, I'll show you what I mean by that. Basically, London's dominance of the market enforces the key spreads. All right, so simply because there's just so much volume coming through London, any other currency or spreads on currencies that may exist at the same time tend to be arbitraged out. So really, the spread that goes through London is at the end of the day the one that we're going to go with. Fluctuations are caused by actual money flows as well as expectations. What I mean by expectations, well, expectations in GDP, inflation, interest rates, budgets, and trade deficits. That's why these data prints are key to watch. All right. Large bank advantages created by order flow transparency. What I mean by that is the large banks can actually see the order flow that is coming through, and they are able to then take a view on what a currency is doing as well. All right, so as I basically mentioned earlier on that previous slide, the most heavily traded pairs, 28% would be the euro-dollar, followed by the dollar-yen, and then basically followed up by sterling-dollar. The US dollar is involved in 84% of all transactions. The euro is sitting at about 39%, the yen 19%, and the pound dollar is basically, the pound is roughly around about 13%. So those are the ones that sort of get traded the most throughout the course of the day. Okay, in terms of market psychology, and you basically would have seen this a hang of a lot over the last few years. Flights to quality. Basically, crisis creates moves to markets perceived as safe havens. things like the US dollar, the Swiss franc, gold. These are all determined as or perceived as safe havens, which is not necessarily always the case. If you've had a look at what gold has done recently, you wouldn't really call it the safest bet right now. But whereas if you had to look at something like the dollar, well then we would say, yeah, sure, let's go and have a look at that. There will be greater demand, thus a higher price for currencies perceived as stronger over their relatively weaker counterparts. Currency markets often move in visible long-term trends. Although currencies do not have an annual growing season like physical commodities, business cycles do make themselves felt as well. All right, so just got to bear that in mind when we are considering currency markets. They do have various aspects that do affect them. A classic one here: buy the rumor, sell the fact, which is one of the anchoring sort of a cognitive bias. You really want to kind of try get in based on the rumor rather than once the fact hits, as generally by that the time that the fact has come out, the price has already moved. And then things like economic numbers tend to have a talisman effect of key numbers really could be very instantaneous. So for instance, if we have a look last week, we had things like non-farm payrolls coming out, which really had a big impact on what the market did. And then you can obviously use that in conjunction with technical trading. Now, technical trading can play a part in where prices can be perceived to be moving to. Okay, so some of the macro factors that we're going to look at today is political conflict, equities and risk appetite, and then just some of the correlation between oil and gold and currencies as well. So just as an example, I mean, if we went back to 2008, and we had a look at Thailand, for instance, and what we had there was, let's have a look, see what this was here. Emergency rule in Bangkok asked after at least one man died in clashes. I mean, so like any political risk can obviously have a big bearing on, obviously, on the market itself. If we put that into perspective right now, a lot of people are questioning what will happen to the rand if Madiba has to pass away. So these things do play out on the currency markets. As I've got here, just a couple of key points. Generally, currency markets avoid political risk. Sell first, ask questions later. So just tend to get out as quickly as possible if there is any big political risk on the horizon. Okay, in terms of risk appetite, a lot of you probably watch Bloomberg channels or something similar, and you always hear about risk on, risk off. Okay, investors' appetites for risk rise and fall over time, and at times they are more likely to invest in high-risk instruments than during other periods, such as during the 2009 recovery. The 2008 financial crisis was considered a risk-off year, in which investors attempted to reduce risk by selling existing risky positions and moving money to either cash positions or low to no risk positions at all, such as the bonds. All right, so just always be aware of what the chaps are saying on Bloomberg in terms of risk on, risk off, just so that you can start to get an idea of how to structure your particular trades. Should you be getting into currencies at all if it's a risk off year or risk on year? Some of these indices and currencies have fairly deep correlations. One of them, which I've taken as an example here, is we have the S&P 500 index, which is the top 500 stocks in America, and we've compared that to the US dollar versus the Japanese yen. We've got this here on a weekly chart, and this is basically just an indication of, I just wanted to show you that there is a correlation between the dollar yen and the S&P 500. So what we could obviously start to look at is try and understand the relationships between these various different tools. Okay, and I've just taken it one step further here. I've now broken it down to an hourly chart, the blue line being the dollar yen, the red line being the S&P 500, and you can see that there's fairly strong correlation here. So we can take advantage of these sorts of things. So if we, not always as gospel, but surely if something is tending to affect the S&P 500, well, then we could possibly look at a potential trade on the dollar yen there as well. Okay, we basically have an oil chart here for you, and oil versus the euro dollar has had roughly about 70% correlation since the start of 2008. Why? Because the US economy is most sensitive amongst the G20 to the price of crude, but note the divergence lately. So if you had gone back through to 2008, 2009, all the way through to 2011, we had extremely strong correlation between the two products there. And as a result, or well, recently we've seen a divergence just as a result of just the euro being under pressure. In terms of gold, well, gold and the Aussie dollar, as we can see here, very, very strong correlation between the two as well. So there we would look to be trading that as well. So just bear these relationships in mind. So we're looking at gold versus the Aussie dollar. We're looking at oil versus the euro dollar. Another correlation we could look at is S&P 500 versus the dollar yen. All right, so some of the micro factors that I want you to get used to looking at on a daily basis. You would find these on the economic calendar, and I'm going to talk about that later on. But some of the key macroeconomic data we're looking at is non-farm payrolls, your ISM, so that's basically your manufacturing. We're going to look at inflation and then just market sentiment as well. All right, so labor data. Why do we care about it? Why is it so important to the trading markets? Well, firstly, if people have jobs, it means they have greater income, they can afford to buy things, and therefore the economy is going to grow. All right, in G20 economies, the consumer represents roughly 60 to 70% of the GDP. Okay, so that is why we always want to know what is going on with non-farm payrolls. That's why it was a big trading week last week. Okay, so just basically looking at the US unemployment rate, and here we have a chart of the non-farm payrolls. This is taken straight from Bloomberg, this particular chart. All right, so during the mature phase of an economic expansion, monthly payroll gains of 150,000 or so are considered relatively healthy. Okay, so anything below that, the economy is in a bit of a struggle. In the early stages of recovery, though, gains are expected to surpass 250,000 per month. All right, so right now, as it stands, we can see it's getting up there in terms of recovery. It's taken a little while to get there, but it's certainly making its way up that way through towards the recovery stage. Okay, so the PMI, which is basically the state of business at the moment, it basically measures the health of business. The data is compiled from a survey of around 400 purchasing managers in the manufacturing industry. And basically, if it spits out a number that's greater than 50, it means that we've got expansion. Anything less, we're looking at contraction. All right, so let's just have a look at another chart here of the U.S. manufacturing ISM. ISM manufacturing index is constructed so that any level at 50 or above signifies growth, which I've already mentioned. A level above 43 or so, but below 50, indicates that the U.S. economy is still growing, even though the manufacturing sector is contracting. Any level below 43 indicates that the economy is in recession. All right, so currently up to June 13 there, that was the latest stat. We came out above 50, so we're looking for growth there, which is a positive, and which is obviously bears on the market right now as we see the U.S. market trying to make a recovery. One important thing that we can never rule out is obviously inflation. Inflation basically explains how interest rates are set on everything from your mortgage and auto loans to treasury bills, notes, and bonds. As the rate of inflation changes and as expectations on inflation change, the market adjusts interest rates. The effect ripples across all stocks, bonds, commodities, your portfolio, often in a very dramatic fashion. Okay, so essentially all things being held equal, if hotter inflation generally leads to higher interest rates, higher rates generally lead to higher currency. All right, so let's just say that again. Hotter inflation generally leads to higher interest rates, higher rates generally lead to a higher currency. All right, and let's just have a look at the Consumer Price Index, which is basically the most widely followed monthly indicator of inflation. Once again, this is taken straight from Bloomberg. the CPI is considered a cost of living measure since it is used to adjust contracts of all types that are tied to inflation. All right, so what we have here is the month-on-month change, the CPI, less food and energy as well. So, you know, we can do our analysis off these various different CPI numbers as well. We use that in conjunction with our other data releases as well over the course of a week, of a month, of a day, and then we can come up with a fundamental view of the market. All right, so what we have here as well is I've included CPI versus oil. Okay, oil is a major input in the economy. It's used in critical activities such as fueling, transportation, and heating homes. And if input costs rise, so should the cost of end products. All right, so as an example, or I've got two examples here. In the 70s, oil prices increased from $3 to $40 during the oil crisis. CPI at that time doubled from 41.2 to 86.3. All right, so it was a massive increase in inflation as well as the oil price. You know, and then just going through into another example during the Gulf War, what you saw was the correlation diminishing. All right, so during the Gulf War, oil doubled from $20 to $40 a barrel, while CPI remained relatively stable. So the correlation is almost slightly diminishing there. I'm not quite sure why at this point in time, quite honestly. But you do want to sort of keep an eye out on oil, as I've already mentioned, because it's so critical to the economy in terms of the various activities that it is used for. All right, so here's a quick snapshot. What we're looking at here is the Dow Jones 30, or the Wall Street, versus your Euro Yen. And what we saw happening here was the Dow Jones dropping as a result of the economic factor that came out. As a result, the Euro Yen dropped as well. So there is correlation between those two entities as well. Here's a micro trade example. And what this was effectively saying was the Eurozone trade balance was less than what they had forecast. And as a result, we saw the euro-dollar decreasing quite significantly. All right, so because the Eurozone wasn't doing so well, the dollar strengthened against the euro. This is basically an example of a monetary policy trade example where the RBA cut its rates by 100 basis points. So there we can see in terms of monetary policy that really did have a significant effect on the market going forward, and this was obviously on the Aussie dollar. You know, that really did come off a hang of a lot. All right, so where do I find out about all of these news data and when it's coming out? You will find it on an economic calendar. This one you will find on our website under research on our homepage. You will find the economic calendar. And if we just have a quick look here, we can obviously make sure it's adjusted to our time zone. And you'll see up on the top left-hand side here, we've got GMT +2 Harare Pretoria time, DST off, which is daylight savings times. We will click submit. We can also filter this as well to what is relative and important to us. All right, so you know, if I had to look at this, I think I took a snapshot of this last week or the week before. Oh, there we go. It was the June 27th. Basically, what I was looking for, anything that was important. So anything that with three red little balls is going to be significant for that particular currency. All right. So what we had there at 230 coming on for the US dollar was the initial jobless claims. If you click on initial jobless claims, it gives you an explanation of what that is, what the forecast was, what the previous numbers were, and then I also just like to have a look at the historical prices as well. It tells you exactly what initial jobless claims is. A higher than, well, in this instance here, a higher than expected reading should be taken as negative or bearish for the dollar, while a lower than expected reading should be taken as positive or bullish for the US dollar. So I want you to look at this thing first thing every single day, or certainly at the beginning of the week as well, just so you can prepare your trading week as well. Okay, so in terms of market sentiment, by making use of information on the net speculative positioning of currency futures and by observing the market reaction to news, you will be better equipped to gauge market sentiment. While it's sensible to trade in the direction of the current sentiment, it can be profitable to trade against sentiment. And I probably wouldn't suggest that initially when you're looking to get your education underway. I would rather trade with the market sentiment. Just go with the trend. The trend is your friend, as they say. Just an example of what I'm talking about here is looking at the COT report, which is essentially the Commitment of Traders report. This comes out every single Friday. I will be doing a webinar specifically on the Commitment of Traders report because it is a fairly advanced one. But it basically indicates extreme positioning of the market, or when the market seems to be feeding off false euphoria. Basically, you will see all the orders that are in place throughout the market for various different products. So it gives you an idea of what the future sentiment should be. I mean, are we going to have a bullish market or a bearish market? But as I say, keep an eye out for that particular webinar that I will conduct, because as I say, there's a couple of different ways to trade that COT report. Keep in mind that currency prices are expressed perceptions of traders. Let me say that again. It's expressed perception of traders. And market sentiment is the blood that drives the market on the whole. Sentiment can show you what to trade, and then technical analysis will tell you when to trade. Okay, so what we could look at here is a trading technique called a decreased volatility breakout. Currency prices experience a periodic cycle of varying volatility from low to high and vice versa. This usually appears after a sharp volatile move where the bulls and bears call a truce until they work out their next move. The longer the period of decreased volatility, the more intense the breakout is likely to be, as bulls and bears might find themselves on the wrong side of the trade in the restful period and will exit their positions, moving prices further from decreased volatility zone, which could form triangles. What I'm talking about there, I'll explain it to you at the end of the webinar, where we look at price movements and shapes on the charts. This strategy works well on daily or weekly charts rather than an intraday chart. So for those of you who are looking to get into a longer term trade, this will work well. Put together as much information as you can to support a particular breakout direction to avoid false breakouts. All right, so we want to use this in conjunction with our fundamental analysis. And I'm going to talk to you about false breakouts just now, further on in the webinar. A carry trade, this is done quite a lot with the big banks. It's a long-term fundamental strategy that involves selling a certain currency with a low interest rate and using the funds to buy a currency which gives a higher interest rate. Typically, high interest rate currencies, the British pound, New Zealand dollar, Aussie dollar, Canadian dollar. Low interest rate currencies, Japanese yen, and your Swiss franc. Okay, and for those of you who are keen on trading around the news, this is a pretty good way to do it. It's called news straddling. It enables traders to take advantage of important events without needing to rely on any in-house analysts to say what will happen in currency pairs if the actual number comes in, how many points more or less than consensus. At the core of the strategy is to get in and out the market quickly without slippage. All right, so you really have to be on the ball here in terms of your news straddling. What you'll obviously do is you will do a long trade as well as a short trade at the same time, but you've got to be extremely, extremely quick as the data comes out. Okay, so what we're going to talk about here is pivot point strategies. Now, a lot of you ask me or come through to your account managers and say, please explain your daily technical level reports that we send out daily. All right, that daily technical levels are all based on pivot point strategies. All right, these things have been traded for many, many years to determine critical support and resistance levels. As the charts will show, pivots can be especially popular in FX markets since many currency pairs tend to fluctuate between these levels. Range-bound traders will enter a buy order near identified levels of support and a sell order when the asset nears the upper resistance. Pivot points also enable trend and breakout traders to spot key levels that need to be broken for a move to qualify as a breakout. It's pretty good when the market opens, just to give you an idea of the movement for the course of the day. And having an awareness of where these potential turning points are located is an excellent way for individual investors to become more attuned to market movements and make more educated transaction decisions. Right, so by definition, a pivot point is a point of rotation. The prices used to calculate the pivot point are the previous period's high, low, and closing prices for a security. Okay, so we'll take the previous day's high, low, and closing price, we split it into a formula, and out pops a whole bunch of price levels where we're expecting it to go for the course of the following day. As I've already said here, the prices are usually taken from instruments' daily charts, but pivot points can be calculated using information from hourly charts as well. But most traders, quite honestly, will take their pivot points from their daily charts and then apply it to the shorter term time frame, so like a 30-minute time frame or a 15-minute time frame. If a pivot point is calculated using price information from a shorter time frame, this tends to reduce its accuracy and significance. And that bears true really for all your indicators. You really want to get your data from the long-term time frames. Okay, so let's have a look at an example here. So here we basically have a chart with our pivot points plotted on there. And what you'll see is, well, quite a few lines, quite honestly, but let's just break it down here. What we'll see in green here is our pivot point. And hang on, let me just get my tool here. Okay, so there's my pivot point for the day in green. And then what the pivot points calculator is a resistance level 1, 2, and 3. Okay, so those are those red lines there. And then on the conversely, we have the S1, and if you had to zoom out on this chart, you would have S2 and S3 somewhere down there at the bottom. Okay, so this chart shows a common day in the FX market. The price of major currency pair, and we're looking at the pound dollar, tends to fluctuate between the support and resistance levels identified by the pivot calculations. The areas circled in the chart are good illustrations of the importance of a break above these levels. All right, so these yellow ones I've drawn in here are called midpoints, which are just essentially the midpoints between your pivot and R1, your R1 and R2. They can also be used as well, relative levels as well. But what we see happening here is, firstly, we see this the price moving towards your R1. We get a little bit of resistance there, but as it breaks through that, and that's our first target here, people. So we would look to get in down here at this point, round about this pivot point, and look for it to go towards our R1 as our first target. What we could do is we can close out our trade completely at R1, or we could possibly close out a portion of our trade and let the remaining portion of the trade then carry on through to our R2 and then hopefully our R3. So it just calls for a bit of active management for this particular technique. All right, so I'm just going to read what it says here. What we also see when trading pivots in the FX market is that the trading range for the session usually occurs between the pivot point and first support and resistance levels because the multitude of traders play this range. All right, so you'll tend to get the majority of the movement between your pivot point and R1, and vice versa. If you're having a down day, it would be between the pivot point and S1. Okay, so let's talk about the significance of market opens. Okay, one of the key points to understand when trading pivot points in FX market is that breaks tend to occur around one of the market opens. The reason for this is the immediate influx of traders entering the market at the same time. Now, traders will tend to have a look at how prices traded overnight, what data was released, and then adjust their portfolios accordingly. During the quieter time periods, such as between the US close, which is 4 p.m. Eastern Standard Time, and the Asian opening time of 7 p.m. Eastern Standard Time, even sometimes during the Asian session, there can be a fairly quiet trading session. But generally in those times, prices may remain confined for hours between the pivot level and either the support or resistance level. And that is the perfect time for people who are looking to trade a range-bound situation. Okay, where you basically have a support and resistance line in place, and the levels just tend to bounce between those two points. Okay, so here let's have a look at a technique that we can use here. This chart shows a pivot point being used in cooperation with candlestick patterns to predict a trend reversal. So what we see happening here is the price approaching our pivot point, What we're hoping is that we're going to get some kind of resistance off the pivot point if we're looking to short. We do see that happening. Let me get my tool again. We do see that happening with our candlesticks. There's a classic reversal pattern here called the doji. We see a big bearish move down back through the pivot point. And what we would look to do here is once again short this with S1 as our daily target level. All right, that's the first target level we're looking for. What you could have done here in this situation is once again look at your candlestick formations. We would have completed our short. We would have taken our profit down here at this point of 1.2897. Looking at these candlesticks, I probably could have gone for a speculative move back up, actual buy trade to bounce off this S1 back up to your M2 here, and we probably would have closed out here for another trade. Conversely, I could have once again done another short from this point back down through to our S2 as a target. So there are a couple of different ways that you can actually utilize these levels, but as long as you've got them visually inputted on your chart, it becomes a lot more easier to decipher. Okay, so that was a breakout sort of strategy. What we're also looking at is pivot point validation. Okay, so another strategy that we look at for prices to actually obey the pivot level rather than breaking through it, and we're looking for them to be validated as solid support or resistance zone. In this type of strategy, you'll look to see the price break the pivot level, reverse, and then trend back towards the pivot level. If the price proceeds to drive through the pivot point, this is an indication that the pivot level is not very strong and is therefore less useful as a trading signal. However, if prices hesitate around that level or validate it, then the pivot level is much more significant and suggests that the move lower is an actual break, which indicates that there may be a continuation move. Okay, so here we go. We have a sort of a pivot point validation. This is on a 15-minute chart with the pound versus the Swiss franc, and shows an example of it actually obeying the pivot line. So for the most part, prices were first confined within the midpoint and the pivot level. As the European market opened, it rallied and broke above that pivot level quite significantly, as we see there in that circle. Prices then retraced back to that pivot level, where we see this big red doji getting formed here, or spinning top, or what I suppose you could call it, and proceeded to rally once again. The level was tested once more right before the US market opened, which was at this point here. It held up once again, and at which point traders, you could have placed a buy order on this pivot level, which had already proved to be a significant support level. Okay, so it broke through the pivot level. It came back down. It tested it. It held there. So we know that this level is fairly significant. As the US market opens up later that day, which is over here, it gets tested again. The price holds, so we know it's significant. We can look to make a nice buy off this level here. All right. Okay, so I'm going to repeat these chart patterns every now and then because I want them to really get drilled into your mind. And hopefully if I talk about it enough times, it'll become second nature to all of our clients, because it really is the basis of technical analysis as well in terms of spotting your support lines, your resistance lines. But let's just go through them. Firstly, we're going to look at some reversal patterns, and this is where we're looking to do a trade against the trend. All right. So what we have there is your double top. It'll make almost like a M formation. And what we'll see here, it'll hit a resistance line. We'll have then input basically a support line at the middle of the M, and we would actually look to short as it breaks through that support line. Conversely, we have a double bottom, which would be a W shape. We see the support being made here at the bottom of the W. The price retraces back up to form the middle of the W, and we would then look to actually buy as it breaks through that top of that midpoint there. I like to use rising and falling wedges, and what you see happening is the price would be increasing, decreasing, forming higher highs and higher lows as well. And what you see happening here is if you just draw in two lines, as the price approaches the apex of the triangle, we should see it break out to the downside. That's on a rising wedge. Conversely, on a falling wedge, we have the price decreasing here. It's making the lower highs as well as lower lows, and eventually what we see as it approaches the apex is that it should break out to the upside. Same story here for head and shoulders and inverse head and shoulders. What you'll see happening here is that we have the shoulder line getting formed here with the two different prices. This would be our headline, and we would actually look to short this trade as it breaks through the neckline here. Conversely, with your inverse head and shoulders, we would actually look to buy it as it broke through the neckline to the upside here. Okay, so continuation patterns. All right, so this is what I was talking about in terms of being range bound. And what we see happening is we have a support line as well as a resistance line. And what we look to take advantage of is this trading within this range. We would basically look to buy off the support and then sell off the resistance line. What we have here is your flat top or ascending triangle. We have an uptrend here, but it keeps hitting a bit of resistance to the top side. Eventually what happens is as it approaches the apex, it then breaks through the top resistance level to the upside, and that's where we would look to enter into our trade. Conversely, on the flat bottom or descending triangle, we have a downward trend. Same story here where we would have our support line being formed as the base. As it approaches the apex of the triangle, and eventually the support gives way to the downside and continues on in the downtrend. Symmetrical triangles are very similar as to what these flat top triangles are, and flat bottom triangles. We would have a sort of a triangle forming to the upside of the downside here, and we would obviously expect it to, if it was an uptrend indeed, then we would expect it to carry on to the upside as it approaches the apex. Okay, people, that is pretty much it for tonight. I have been through quite a lot of things. What I will be doing is at a later date, I will be expanding on some of these things as well. So, for example, the COT reports. I have actually recorded a more in-depth look at pivot points as well. So that will be out. Well, in fact, the pivot point video is already out on our YouTube channel. Please, for those of you who haven't already done so, please go visit that YouTube channel. We have just loaded up a whole lot of new videos. One of which was just some platform training in Afrikaans, how to trade pivot points, and how to use the Guardian Angel tool as well, which is a great tool to utilize for your stop loss calculators and all that kind of a thing. So go and check that YouTube channel out, and certainly please try listening to these weekly webinars that we're conducting. All right, so I'm going to just stay on the line now for just the better part of half an hour or whatever the case may be. Hopefully we can field some questions and just have a discussion point here as well. But other than that, thanks very much for listening in tonight. I'll just wait back here and just hopefully wait for your questions to start filtering through. Okay, I've got a question here from Morena. Is it possible to give longer time frame daily technical analysis as well? Morena, I think what might be useful here, and I've been looking for quite a decent little indicator for quite a while. For those of you who are using the MetaTrader 4 platform, I've managed to find a pivot point calculator which not only calculates daily pivot points, but it calculates weekly as well as monthly pivot points as well. So I tell you what, for those of you who joined in tonight, I will send that out to everyone, and hopefully it should just give you a bit of assistance. But what you must remember as well, Morena, that all the techniques that you're using on your shorter term time frames tend to be a lot more effective on your longer term time frames. So I would do my technical analysis starting from a longer term time frame, and then drill down specifically into the shorter term time frames to identify a more specific price that I would look to enter. Got a question here from Matthew. How do the strikes affect gold prices? SA is still a large producer of gold, so surely this would impact the prices. Matthew, like it's quite a difficult one to answer really, because you would assume so, but the gold price itself really has kind of disassociated itself from the South African gold mines, as you would have seen. You know, what you've got to bear in mind is that even though we might be producing a similar amount of, or a decent amount of gold, we don't own it. You know, it's all offshore stuff that is being really the major factors, if you want to call it that, in terms of determining what is going on. So there is obviously the big relationship there between the dollar and gold there, which is that inverse correlation. You know, so that's where the big players tend to make the gold price move itself. Got a question here from Mitya. As far as news item releases, what is the best way to get news quickly and as they happen? Well, I always used to use the Bloomberg Television, but since they've merged with Business Day, they don't always have the latest data releases. So what I've resorted to now, and you know, you could obviously utilize sort of your eco calendars, but for those of you who are using Twitter, very often you'll find that the big traders offshore will actually tweet about a data release about 10 or 15 seconds before the market actually releases it, and those 10 or 15 seconds can really be massively advantageous to you. So, you know, for those of you who are on the Twitter, you know, on the Twitter feed, please go and try to search out some traders who are happy to actually put out some news data like that, because, as I said, it, you know, it basically saves you valuable seconds in terms of identifying a trade. Got a question here from Fearless. How many trades does a good trader do in a day? Very tough to say, Fearless, quite honestly. I mean, I've seen traders, successful traders, do in the vicinity of 200 to 300 trades a day. I've seen traders do 1 trade a day. It really just depends on the strategy that you're utilizing. Moreno, I always look in terms of time frames. I always look at sort of my monthly, then I drill down to weekly, then I drill down to daily. So I've identified the trend from a long-term perspective, and then I utilize my sort of technical analysis on the shorter-term time frames. At any given time, really, I'm probably looking, you know, over the course of the day, I'll probably look at like a 15-minute chart or something like that. But that's only because right at the beginning of the week, or whatever the case may be, I've already looked at my daily, my weekly, and monthly charts. Do candlestick formations on shorter time frames indicate the same indicators as on long term? You know, candlesticks, it is basically exactly the same as what I said earlier on. You'll basically get a much nicer indication from the longer term time frames, simply because the data tends to be a lot more smoothed out. You know, it tends to miss out all the volatile sort of ticks and what's the right word? Yeah, basically the ticks in the market. But yeah, I think you know, just coming back to the Twitter thing, I would probably start off just by getting onto Twitter. I mean, like I don't utilize Twitter a hang of a lot. I just don't have the time sometimes. But But I would certainly just do searching in the sort of finance industry, and you will, after a time, you'll come across chaps that who Twitter quite a lot with regards to the financial markets. Any more questions, guys? While I've got you all on the line here, are there any particular things that you want me to discuss in forthcoming presentations? Any more questions, guys? Got a question there from Matt. Wants to know how news and events drive markets. Just as a quick one, just worth discussing, Matt. Very often, we tend to wait for these big news announcements to come out, and one of two things can happen. Either the forecast is spot on, and nothing happens in the markets because the guys have actually priced in that those stats already, and the market does absolutely nothing. And then obviously, if it's better than expected, then we obviously react to that. So that's really what happens with these things. Then what I would also do is identify the ones that are pertinent or important to the product that I am trading. All right. So obviously, non-farm payrolls is a big one because it affects every facet of the market. So like the ones I mentioned tonight, really they are the sort of the big guys. And yes, you'll have the same kind of numbers coming out throughout the world in terms of GDP and Canadian dollar and the yen and all these sorts of things. But the big mover and shaker is the US dollar events, because that's obviously what the big player in the market. This is just from Petros here. This is a sort of a case of contention, and it's obviously not nice to talk about because it's a fairly sensitive subject. But Mandela's health affecting the market itself. I believe personally that the event of his death probably could be priced into the rand already. I think probably what you'd see happening is a little bit of a flutter on the equity markets when he does pass away. But as I say, I think a lot of it's already priced into the market as well. But that's only one man's view. It's obviously up to you and to come up with your own as well. Any more questions, guys? Okay, I think I'm going to call it there for tonight then. Thanks very much for listening in. We obviously will keep you posted on what we will be talking about next week. If you haven't already done so, please just go and do a little bit of revision on the other videos that I have recorded. And then if there's anything in particular that you want to talk about, there's my email address right there, markp@trader24.com. Send me an email. Let me know what you want to talk about in terms of presentations, and I'll put it into a presentation for you. Other than that, thanks very much for attending, guys, and I'll chat to you soon. Bye-bye.